There are tax implications of leaving Canada. If you are a non-resident of Canada for tax purposes, there are a bunch of things you need to know so that you don't end up having to pay a lot in taxes. Okay, so you want to know ahead of time before leaving Canada what it means to be a non-resident of Canada. In this video, we're going to talk about residency. We're going to talk about what it means to be a resident, how you become a non-resident, and how much more tax you have to pay if you are a non-resident. So we'll start off with the residency test. There's two things you need to look at. The residency based off factual residency or deemed residency. So the first thing we look at are residential ties. So this is factual. So in order to be a factual resident of Canada, you must have significant residential ties to Canada, home in Canada, spouse or common law in Canada, dependents. Then if you don't have those things, then we're going to look at the next thing, which is secondary residential ties. This is personal property in Canada, such as car or furniture, social ties in Canada, such as memberships in Canadian recreational, religious organizations, economic ties, such as a Canadian bank, Canadian driver's license, a Canadian passport, etc. Okay, so that's the residency test. If you have any of these three significant residential ties, you will be considered a resident of Canada for tax purposes. This is, again, a tie-breaking rule. There's no way of knowing for sure. It is just that, let's say, if you do have these significant ties, you are more likely to be considered a resident of Canada. If you have none of these, but some of these secondary residential ties, then it's kind of subjective. You don't really know for a fact, okay? So there's no really written rules around, oh, maybe you need to have 2 out of these 5 or 6 or whatever. There's no rules around that. It becomes subjective after. But if you have any of these significant residential ties, then you will be considered a resident of Canada. Now, if you don't have any of that, you can still be considered a deemed resident of Canada. So there's 2 ways. So you live outside of Canada, you're not considered a factual resident, and you have one of the followings. You're a federal or provincial government employee, a member of the Canadian Forces, a person working under the Global Affairs of a Canada Assistance Program. So we're not really going to talk about that. Those are very specific. Or you stayed in Canada for 183 days or more in the tax year. So again, you do not have significant residential ties. You are not considered a resident of another country under a tax treaty. So if you stay 183 days or more in Canada, that's more than half a year, more than 6 months in Canada, you are considered a deemed resident. Now, residency is essentially important because if you're considered a Canadian resident for tax purposes, you pay tax on worldwide income. Yes, so any income earned outside of Canada will be taxed. That means if you have a rental property in Mexico, anything like that, that'll be considered worldwide income and you'll pay Canadian tax on that. Foreign pension, yes, you'll pay Canadian tax on that. So very important. Now, if you are considered a non-resident or a deemed non-resident, so a deemed non-resident is essentially you have residency in another country, okay, under a tax treaty between Canada, you'll be considered a deemed non-resident. So you meet residency of another country, then you're considered a deemed non-resident. Or if you don't meet any of these ones, you'll also be considered a non-resident. Now, why is residency important? Well, for non-residency, you have to pay a 25% tax on amounts that are taxable under this part tax, okay? However, this can be reduced to a lower rate based off a treaty between the countries, Canada and the other country. But as a rule of thumb, and there are no treaties, you don't look into it, you're going to pay 25% withholding tax. So that means if you have a Canadian pension, old age security, 25% will be withheld, right? So that's actually quite a bit. If we're talking $10,000, that means $2,500 will be withheld from you. So quite a bit and quite bad for you there. Okay, so if that happens and you are considered a non-resident and you want to see if there's a treaty, you can go onto the website and figure out this non-residence tax calculator. You select the country you want to be. So we'll just start with Argentina here. We put $10,000 in our old age security. How much will we have to pay? They have a 15% one, which is very good. If we go down to Bulgaria, 15% if we go, let's say we'll go down to Uzbekistan, we can see that there's 25%. So now they don't have a tax treaty here with Uzbekistan, so you're going to have to pay 25% withholding tax. That means any income that you earn in Canada as a non-resident, 25% must be withheld. And again, if someone is paying you, they'll have to file what we call an NR4 slip. Okay, NR4 slips. So these slips are very not a lot of companies, not a lot of people like to have these NR4 slips, so it may be harder for you even to have to find a job if you are considered a non-resident. All right, so you're not being sure, you're not really quite sure if you're a resident or not, you can fill out a determination of residency status form. All right, and if you fill out this form, it's this NR73 form, then a CRA agent will take a look. You're going to put in all your information about why you're leaving, and they're going to decide whether you are a resident or non-resident for Canadian tax purposes. So this means that a CRA agent will actually take a look at it. If you actually don't want that and you want to be considered a non-resident, then you will file your final T1 form, and you're going to click that you are this is your final T1 form, because you are going to become a non-resident of Canada in the following year. All right. So if you want to be a non-resident for sure, you just file that. If you're not sure, you can file this NR73 form, go from there, and they'll double check that and determine it for you. Now, for example, if you want to stay away from that 25% tax treaty rule, then you can fill out this application by a non-resident of Canada for a reduction in the amount of non-resident tax required to be held. Obviously, you don't want it to be 25%. You want it to be as low as possible. And you can file this through another form to have them maybe accept that, so it's reduced to a lower percentage. 25% is actually a very high amount. And of course, this may not be feasible for everyone. So they have this form that you can fill out. Now, if you are planning on filing your tax return this year for the 2025 tax year, use Wealthsimple Tax. They are the best user-friendly software out there on the market. If you click the link in the description, you'll get $25 if you fund your account with $100. Remember, this is just general tax information, not personalized tax advice. If you like these videos, like and subscribe to the channel for more practical tax guidance videos.